Hi, Paul Durso here with another section of Mastering the Art of Financial Planning. Today, we're going to be talking about risk management, mastering the art of eliminating or reducing risk. Okay, so what we're going to do is we're going to talk about a couple different types of risk. There's two major types of risk out here that we're going to talk about. The first one is investment risks. And there's about 6 major investment risks that we're going to be talking about today. Then we're going to be going into lifestyle risks. The life that we live is incredibly valuable. So what we're going to talk about is the 4 major risks that we have to plan for and account for as we live our life. Now, before we jump in to talk about those elements of risk, let me ask you 2 big questions. The first one is, how much risk are you comfortable taking? So risk is one of those things that's very hard to come to common grounds or to come to grips with when it comes to evaluating it. Some people think certain elements of risk are totally acceptable where somebody else might not, and vice versa. Risk is very personal. I think we could all agree that certain risks are expected and certain ones aren't, but at the end of the day, our threshold and tolerance to risk is definitely very personal. And the question to you is, how much risk are you comfortable taking? Or even better asked, how much risk should you be taking? That's an even more appropriate question, but even much more difficult to ask. We're going to get into a lot of that in the second part of this video today, when I'm going to be going over an actual simplicity plan. But before we jump into an actual plan, let's talk about the 10 different risks that we're going to be reviewing today. The first is, when we're going to be dealing with investment risk, is market risk, otherwise known as systematic risk. You cannot diversify out of this. This is one of the most widely known risks out there, which is the volatility of the market, the S&P, the Dow, the NASDAQ, any index you want to grab, stock. It's the ups and downs volatility that drives us all crazy. It's called market risk. And we think from time to time we can outsmart the market, or we can get around its volatility, or we're just the best stock picker out there, or you've got the best stock picker out there. But at the end of the day, it is impossible to outsmart market risk. You cannot do it. It's impossible to eliminate it. The next thing is called interest rate risk. This applies to the more conservative investors out there that might like fixed products like a CD or a fixed annuity. And where this risk really comes in is when interest rates are in a rising market like they are right now. You might lock yourself in at a low rate, and as interest rates go up, you're kind of trapped in this lower rate investment when you could have doubled your rate of return if you would have just waited. So like all risks, timing really matters. The next one we're going to be talking about is inflation risk. This applies to everybody, every investment, everywhere. There are zero investments without risk. Not a single investment in the marketplace today, anywhere, does not have a risk, because inflation risk applies to all of them. There's nothing that can circumvent inflation. Okay? It's something we all have to deal with. There's a 2-headed monster from our federal government we have to deal with. And the 2 biggest concerns are inflation and taxation. And almost every single investment out there applies to both of those. All of them apply to inflation. The next one we're going to talk about is business risk. You know, how the companies and their financials are going to rely on the stock price or selling power of whatever they're trying to sell. It's going to affect one another. So business risk is definitely something that we have to deal with, but it might not apply to everybody out there. Another one is credit risk. Full faith and credit of the insuring company or the company offering the product. This really comes into play for insurance products. You know, the company's power, the ability to pay its claims is what's called credit risk. The last one that we're going to deal with on these types of risk is called taxation risk. Again, the second head of the governmental concerns that we have to deal with, inflation being the first. The second one being taxation. Nobody can get away from it. It's everywhere you turn. You know, you want taxes to be lower, which is wonderful. We all want them to be lower. And this risk is just something that's very, very difficult to deal with. You can strategize to help reduce your risk in retirement. Good, effective planning can help do that, but it is something that everybody has to deal with. You're not going to get out of paying taxes, but you might be able to reduce them. Okay, so that was the first style of risk that we have to deal with. The second one that we're going to deal with are going to be lifestyle risks. This one's a little bit more personal, a lot more opinionated. The first investment risk that we dealt with, all 6 of those, you know, we could probably all talk about them without getting our heads together and having too many opinions. But when it comes to disability, long-term care, health care, Medicaid, Medicare, you know, these types of risks become a little bit more passionate to talk about because they're so personal. They deal with you, they deal with me, and everybody's got pretty strong opinions about here. One thing that I'm going to do as I go over these, I'm just going to kind of talk through some different styles or strategies that you can discuss with your financial advisor. You know, as you bring these up, you might want to discuss some alternatives out there. So the first one we're going to talk about is disability insurance. This one's pretty easy to talk about, and in the event that you get hurt, you know, you might need disability insurance. So the only time disability insurance is really going to matter, isn't this obvious enough, is while you're working. If you're going to retire, disability insurance is no longer needed, and hopefully nobody out there is paying for disability policy when they're retired. But disability insurance is important and really comes down to if you're going to pay for it, how much disability insurance do you really need? And again, that's personal. That's where you might want to talk to a spouse. I would look for outside policies. Your work might offer them, and that's the power of the group policy. You might get a lower rate. But in today's environments, groups exist outside of employers. It might be a good idea to find a specialist, go online, look for some quotes, and see if you can't lower your disability, get a better rate, more coverage for a lower cost. The next risk that we're going to talk about is long-term care. Wow, I've gotten into a lot of discussions about long-term care with clients over the years. This is a tough one to give recommendations on. I don't want to give my recommendation that you need a long-term care policy and spend all that money and don't use it. I don't want to say you don't need long-term care and then you need it. It's a tough spot to talk about long-term care, but when it comes down to it, it's an industry that is really changing, or has completely changed, I might add. Traditional long-term care policies are almost dead. There's very few companies that still offer them. They're very expensive. They're hard to understand. There's a lot of loopholes you have to jump through. Very difficult to find a good deal on traditional long-term care, because at the end of the day, I think it runs through all of our minds the older we get, the concern for cost of long-term care. Nobody wants to be a burden on our kids. Nobody wants to be in a facility they don't want to be. You know, we want that money to be there, and who can afford it? So you might need a long-term care policy. Well, let me tell you, there are a tremendous amount of opportunities out there that are non-traditional, where you can go and get some form of life insurance that if you happen to go into a long-term care or long-term care stay, you can actually take the death benefit that you would have died and actually use that for long-term care. That's just one form of an alternative source for covering long-term care. There are so many of them out there. Don't feel trapped that you have to go traditional. They're very expensive and they don't even like to pay. So I'd throw the caution out there to you. Be very careful before you do that. There are a lot of alternatives. Talk to your financial advisor. You can call our office. We'll be glad to put you in touch with a specialist that deal directly with this. It's not a big part of what we do, but it's definitely something we're very knowledgeable about. The next thing that we want to talk about is health insurance. Now, this would deal with personal health insurance when you retire, or Medicaid, Medicare. The big disclaimer I like to go over here is healthcare is changing in America and will probably always be in a state of change. And again, this is very timely advice that you need to get from a professional on what you should do. Again, there are a lot of alternative sources to getting healthcare coverage in America today. I know my family, we're on non-traditional healthcare coverage through a group share plan. It's a Christian-based organization, and it's been amazing. We pay a very low premium, and it's a very wonderful policy. I can go anywhere I want. But it's not the big companies, the Blue Shields out there that you can feel so comfortable with, but pay a ridiculous amount of premium. I can tell you 5 years ago when we went off our Blue Cross Blue Shield, we were paying just under $2,000 for a family of 5. Now we're paying less than $500 for that same family with what I would consider better coverage. Okay, so there are a lot, and you might be saying, well, yeah, you're young. Well, you know what? Those same rules and principles apply no matter what age you are to the types of policies that I'm in. Yeah, you might not be able to cover yourselves at 65 or 75 for the same cost of my family of 5 now, but I know a lot of our clients that can significantly reduce their healthcare coverage, might even cut the payment in half or better, and get even remotely considerably better coverage for less cost. So don't feel trapped. Don't feel like you just have to, if you get let go by your company, get on Cobra. Don't feel like you just have to do what they give you or go to the big companies out there and it is what it is. Do your research. You can call our office. I'd be happy to talk to you and put you on a trail. Again, this is nothing that we do. We don't offer health insurance, but I'm pretty passionate about it as a small business owner and what you can do and what's out there to find and see if there's some things that you can do to better yourself and reduce your payments. Now, these are in generality, a lot of the risks that we have to deal with. So what I'm going to do really quick is I'm going to switch gears. And I want to talk about dealing with risk from a financial plan perspective. This is simplicity. It comes on and off in a lot of the different modules and sections that we go over in this online Mastering the Art of Financial Planning. I want to do really quick is jump into a sample plan that we put together for this video. And it's based on George and Cindy Johnson. And they want to live on $100,000 of retirement income. Right now, George is 65, Cindy's 61, and they have about just over $1 million of assets, okay? And the first thing that I want to bring up is, really the question of risk. How much risk should they be taking? What's an appropriate amount of risk? They're above and below ground assets. They've got majority of their assets, 93% of their assets above ground, and 7% of their assets below ground. They are taking a lot of risk, okay? But when it comes down to it, the biggest concern that I want to point out in their plan actually has nothing to do with the 10 risks that I've just gone over with you. It has to do with the fact that when they retire, they need to generate $30,000 of income. You see, when they retire, they're going to have about $27,000 of pension income. They're going to receive about $40,000 of Social Security, but again, they want to live on 100. They're only bringing in 70. That means they have to provide $30,000 of retirement income for the rest of their life. And the reason why I'm bringing this up to you is because there are so many risks out there that are so concerning. Market volatility, interest rate risk, inflation, taxation, long-term care, disability, all these risks that we've gone over, they are very big deal. But I personally believe the number one risk isn't even common, and it's your and my ability to provide the income we need in retirement. This should be the number one risk on everybody's radar. Now, if this risk is taken care of, and you've got all the money you need in retirement, then yes, tackle all those other risks head on. But if you haven't properly identified and planned for this risk, this has to be the first one you check off. Because if you haven't dealt with this, you'll never retire. Once you deal with this confidently from a planning standpoint, and you know without a shadow of a doubt you're going to be able to retire, then wonderful. Let's go tackle the other 10 and beyond and be happy doing it. But this has to be dealt with before you can do that. And I can tell you in other videos in this class, we're going to hit this on specifically in the income planning section, That's exactly what we're going to go over, how to address and plan for your income need over the rest of your retirement years, okay? So hopefully you've gotten something out of this risk model, mastering the art of planning for risk in retirement. But the biggest thing, again, is helping make sure that you've identified all the risks in your life and that you're planning for each and every one of them, with the number one being planning for the income for your future. All right? So until next time, Paul Durso, hope you enjoy.